Another day of a government shutdown, another day of record trading. We are up on this S&P 500 futures session. 30 minutes to go until the start of cash equity trading. I'm Dani Burger. Matt Miller is off today, and Bloomberg Open Interest starts right now. Coming up, OpenAI strikes again, inking a deal with AMD that's sending shockwaves through the chip industry. Meanwhile, Fifth Third scoops up Comerica for nearly $11 billion in the biggest U.S. bank deal of this year. And Tesla leads the Mag 7 higher. The electric car maker teases a product announcement in a series of cryptic posts. So a lot going on this morning, a lot of deals, and in the tech space, it's a big one. The stock to watch this morning is AMD. OpenAI having such an outsized impact on this public market. Shares up, check this out, nearly 36%. It signed a deal of a data center with OpenAI. It could get a nearly 10% stake in the chip maker. AMD expects the deal to lead to tens of billions of dollars in revenue. And let's get more into that story on the AMD OpenAI news with Bloomberg Tech's Ed Ludlow. Ed, what exactly was agreed upon here?
I mean, you have a great command of the basic details, but there's a lot of unanswered questions, right? So it's a multi-year agreement, 6 gigawatts of capacity, which is basically the peak energy demand of a sizable city. The questions that remain is, how is OpenAI going to finance this? Because yes, in the structure, AMD issues OpenAI a warrant for 160 million AMD shares, but they are deliverable in tranches against milestones that will require OpenAI to spend money, right? So the first tranche of stock is deliverable on completion of the first gigawatt of capacity. And what is not answered is, does OpenAI look to some other kind of financing mechanism to make this happen? For AMD, it's a way of getting a bigger foothold on a market in which it is a distant number 2, maybe even number 3 player behind NVIDIA, right? And so OpenAI, in this case, is their golden ticket to the inference level compute that we think we'll need in the future.
Ed, it's not just how do they finance this, it's how do they finance everything that they've been announcing, from deals with NVIDIA to CoreWeave to Oracle. We are talking at least over $1 trillion. Do they have the money to do this?
Yeah, the net commitment that OpenAI has to all of the parties you mentioned is somewhere between 26 and 30 gigawatts, right? So the AMD 6 gig is a significant chunk of it. You know, the question in this case is, how is the structure of the AMD deal different to the NVIDIA OpenAI deal, which had a value of 100 billion, but saw the different mechanism where NVIDIA basically gets a stake in OpenAI. And we don't know whether NVIDIA's commitment to OpenAI was cash or was it chips in lieu of cash. That's what raised the circular financing questions, because NVIDIA basically helps OpenAI to finance the purchase of NVIDIA gear. In this case, very different. You know, AMD is not doing that. They're giving out stock to OpenAI once OpenAI has spent the money. So I haven't answered your question. Does OpenAI have the money? Don't know. What are they going to have to do in debt markets, for example, on top of the other equity raises that they've done in the last 18 months? But we will at least get an opportunity to ask that question. It's critical.
Does this mean anything for some of AMD's competition? When this was announced, Intel shares immediately fell. They're back up. NVIDIA shares have been off all this morning. Does it make a difference to them?
So in the market for AI accelerators or high-performance GPUs, you know, I think AMD would argue that this lets them fight back in some market share of a core player in the AI space. We know that OpenAI, once the capacity is online, is going to use the AMD gear for inference. In other words, running models as opposed to training them. That's very interesting. Does that signal to the market that AMD's technology is better at inference than NVIDIA's? We don't know, but that's a reasonable question to ask. Again, in the broader context of data center, the AI accelerators, but also CPU, AMD is very small compared to what NVIDIA is doing, with a literal technical monopoly in this space. So, you know, until the data center is built and it's not just sand and dirt in the ground, we won't know that.
All right, Ed, thank you for that update. That is Bloomberg Tech's Ed Ludlow with AMD shares up a giant amount this morning, gaining by more than a third. Now to a major deal in the banking world. Fifth Third will buy Comerica. It's an all-stock deal valued at $10.9 billion. Comerica shares are surging on the deal, and Fifth Third is in the red, down just less than 1%. For more, we're joined by Bloomberg finance editor Sally Bakewell. Sally, what is the thinking behind this deal?
So we have Fifth Third, which has a big presence in the Midwest, but has been wanting to grow in the Southeast, where population is expanding. And then we have Comerica, which had sort of muted results last year, has been under pressure to sell itself by an activist investor. And now we have this more friendly regulatory environment under Donald Trump, which is really starting to seep in. We've had a couple of deals this year already with PNC buying First Bank and Synovus merging with Pinnacle. And so this deal is now being seen as a bit of a win-win by analysts. It creates this $288 billion banking combined, and it's the 9th largest bank in the US.
How much of this, I mean, you mentioned a lot of these deals that have been happening, creating these super regionals this year. How much of this is just an easier regulatory environment that lets them do so?
I think it is a significant part of that. We have a very densely populated banking landscape in the US with more than 4,400 FDIC-insured commercial banks and saving institutions. A lot of them have been under a lot of pressure as bigger rivals and fintechs steal their depositors and checking account holders. So for a lot of them, and especially the smaller ones, to survive, they might need to merge, but to thrive, they probably do as well.
All right, Sally, thank you very much for that update. That is Bloomberg's Sally Bakewell. And just flagging in a few moments, we will be joined by the CEO of Fifth Third, Tim Spence, off the back of this nearly $11 billion agreement and acquisition to buy Comerica. Let's get back to big tech, though. Tesla is leading the Mag 7 higher today after a cryptic tease. A product announcement may be coming tomorrow. Let's bring in Bloomberg Global Autos editor Craig Trudell. Craig, I guess that's enough to get shareholders excited. The video is what, like a weird Tesla hubcap spinning or something like that? What announcement could we possibly be getting?
Yeah, I know a few companies that would love to get a 2.5% bump off of a couple of social media posts. But, you know, these couple of video clips that you see, I mean, the second one's maybe a little bit more revealing some headlights. I think in terms of what we know is in the product pipeline for this company, we know that they have a more affordable version of the Model Y coming. So that might be what we're seeing here. Might also be the Roadster, which, you know, we saw a prototype of a second generation Roadster all the way back in 2017. And it's been kind of one of those, you know, products where every couple of years we hear Musk bring it up again, and yet it never sees the light of day. So maybe we'll actually see that coming to market as was promised early last year.
Yeah, these timelines tend to be a little bit squishy, don't they, Craig? Elsewhere, over the weekend, Stellantis planning a $10 billion investment. People familiar telling the team, why would Stellantis go all back in on America right now?
In short, I mean, this is a company whose operations in the U.S. Really could use a shot in the arm. You have brands like Chrysler that have really been sort of neglected the last few years. All you have left in that brand's portfolio is a minivan. And, you know, Jeep and Ram were two real money spinners for this company when there was the combination of Fiat Chrysler and PSA. You've seen a sort of steady decline in this company's sales in the years since then. And, you know, I think there are plants that really could use some investment. You have some real clear examples of that in Belvidere, Illinois. It was a plant that was shuttered a couple of years ago that, you know, under a deal with the United Auto Workers Union, it was agreed to this notion that product would go in there, and yet the company sort of dragged its feet. And I think, obviously, under President Trump, there's real emphasis on investing in the U.S. and building in the U.S. for U.S. consumers. It seems to be the case that, you know, the amount of investment that was announced early this year, right after Trump retook office, is not going to be enough to satisfy the White House. So you're seeing Stellantis sort of go back with an even bigger number for the White House. You know, maybe also in the context as well, I should mention, of higher tariffs coming for medium and heavy duty trucks, which would hit this company particularly hard since they make Ram pickups down in Mexico.
It's a great point. We'll see if $10 billion helps put them back in good favor. Craig, thank you so much. Bloomberg's Craig Trudell. A check on futures with this first trading day of the week, up 1/3% for the S&P 500 after on Friday we closed at your 31st record high for this equity market. A record high, I should say, coming even though gold is hitting a record high. Bitcoin also hitting a record high over the weekend. Yields have been coming in. That is thanks to the weaker private payrolls number last week. But it is a shutdown which rolls on. The NASDAQ up 0.7%. The Russell 2000 up 0.7. It also hit its own record on Friday. That was only the second time so far this year it has done so. So maybe this rally finally, after many calls and hopes that it would happen, is becoming more broad-based. Earnings season will kick off in earnest in a couple weeks' time. Coming up first, though, more on this morning's multi-billion bank deal. Fifth Third Bank CEO Tim Spence will be joining us next. Stay with us for that conversation. You're watching Bloomberg TV. Let's get you some high-interest stories. A look at what's making headlines around the world. France's political crisis deepened today as Prime Minister Sébastien Lecornu quit after just one day under Macron reshuffled the cabinet, citing an unworkable parliament. That surprise move sent French stocks tumbling, bond yields climbing. Lecornu's exit, the third collapse in under a year, leaves Macron scrambling to form a new government, call elections, or risk paralysis just days before a budget deadline. Boeing, meanwhile, they're telling suppliers that it may ramp up 737 MAX production to 42 jets a month as early as this month. It's a sign that the plane maker is starting to regain its footing after years of setbacks. The company's long-term goal is about 53 planes a month. They're going to get that by late next year, they hope, pending FAA approval. Regulators are still reviewing Boeing's progress on safety and quality after last year's near disaster and leadership overhaul. And the government shutdown is now in its second week as the White House warns Democrats that they have one last chance to back a stopgap spending bill before mass federal layoffs. Over the weekend, House Speaker Mike Johnson said he needs Democrats to have a discussion on the Affordable Care Act as subsidies end on December 1st.
December 31st is when the subsidies end. And so we have effectively 3 months to negotiate, in the White House and in the halls of Congress. That's like an eternity. So we need the month of October to figure this out. There's a lot of thought that's gone into that on both sides of the aisle, but we need folks in good faith to come around the table and have that discussion, and we can't do it when the government is shut down.
Let's go back to one of our top stories this morning. One of the biggest U.S. bank deals this year, if not the biggest. Fifth Third is buying Comerica in an all-stock deal valued at $10.9 billion. The combined company will be the 9th largest bank in America. I'm pleased to say that joining the program now is Tim Spence, Chairman, President, and CEO of Fifth Third Bank. Tim, great to have you on. Congratulations on this. Why this deal? Why now?
Yeah, good morning, Dani. Thank you. And based on your last segment on Tesla, I think the next time we have a deal, we're going to announce it by tweeting a photo of a spinning hubcap.
Great idea.
Yeah, listen, we're big believers. We've been patient and quite deliberate as it relates to M&A because M&A is disruptive. And it's higher execution risk than the way that you would grow organically. So in order for us to ever be interested, we have to believe that it advances our strategic priorities, that there's enough of a return premium that we can compensate for additional execution risk, and that at the end of the integration process, we're not just going to be bigger, we're also going to be better. And I think this is one of those rare opportunities that meets all those requirements. The return premium on the deal here is a 22% IRR and about 9% earnings per share accretion to Fifth Third shareholders. It's neutral to tangible book value per share at close, meaning no earn back. And those measures are all better than we can achieve purely on an organic basis. And strategically, I'm really excited because the retail franchise is the thing that has really distinguished Fifth Third over the course of the past 4 or 5 years. We've been the fastest growing large bank in the Southeast, the large regional bank in the Southeast during that period of time. And we now get access to Texas as part of our expansion plan. And in Comerica's case, the crown jewel of their company is this is incredibly strong, disciplined middle market and commercial banking franchise. And I just think the opportunities are so significant to unlock that franchise across the broader combined footprint here. So it's a great opportunity to do it. And I think the window seemed right.
Deals of this size also, Tim, $10.9 billion, they would easily take over a year to close just because of an elongated regulatory review process. What have you heard from regulators this time around regarding this deal? Is it a much easier environment?
Yeah, I think just empirically, if you look at the speed to approval of the deals that others have announced, including one that we saw on Friday, not long beyond 90 days, I believe, from the time of announcement, there's a strong indication here that the M&A approval process is fact-based and it's going to be quick. And that matters because the second that you make an announcement like this, you're essentially fighting a battle with time and getting the deal closed quickly so that you can retain your clients, retain your bankers, and get the combined platform integrated and back to offense. So certainly the indications that there are accelerated merger approvals are an important consideration here. With that said, Fifth Third was approved to bid on the failed banks in 2023. I'm pretty confident we could have gotten a deal approved, in the prior administration as well. It's just nice to know that the process here will be fact-based, but expedient if recent outcomes are any guide.
Well, Comerica seems like a ripe target, Tim. There have been lots of conversations, lots of swirling conversations, I should say, around Comerica, whether they would sell because they had a lot of activists and investors pushing them because of some of the concerns that they mismanaged some of their interest rate exposure. Is there some right sizing that you're looking at to be done once this acquisition is finalized?
I think the CEO of Comerica, Curt Farmer, if he were here, would tell you that the process that the journey the board was on as it related to their strategic options was deliberative, and it predates the involvement of the activists. Nearly as it relates to interest rate risk, the things that make Comerica's business model great, the abundance of operational commercial deposits and all the floating rate commercial loans are what makes it hard to manage interest rate risk. So, they put a hedging program in place and rates moved more quickly than I think probably any of us anticipated. And the byproduct of that is the hedge positions have created a drag. I think we said on our announcement call, it was about $85 million in lost income in the second quarter. So purchase accounting will allow us to deal with that. And the broader Fifth Third balance sheet, and in particular, this diversified range of fixed rate loan origination engines that we operate are going to allow us to manage interest rate risk in a way that, will be more neutral than Comerica had to, just given the nature of its business composition.
Well, with this deal, you also go above that $250 billion threshold where the next level of regulatory burdens, let's call it, kick in. Just how challenging and expensive does it get where you now need to do things like upgrade tech, legal, and accounting expertise?
Yeah, that's a great question. So we were one of the bidders on First Republic, and we had to contemplate 3 years ago crossing that line with a bullet. And when we came out of the process there, we elected just to start to pursue the build out of what we called Category 3 readiness, or 2Xing the bank inside the company. So the expenses associated with full Category 3 compliance are mostly in the run rate at Fifth Third today, and I consider them to be the incremental work that needs to be done here to be immaterial. And will be done well within the allowed time frame. So I'm confident in our ability to get that done.
I realize that you're still working through this, so I hate to jump the gun, Tim. But would you be interested in more M&A after this? You've already increased the threshold. Why not just go bigger?
We've bought one bank in the last 10 years. And we did it because we were not in a survivable strategic position in Chicago, which is a critical Midwest market for us. And the combination of Fifth Third and MB resulted in us actually gaining market share. And I think we're one of only a few large banks that actually has a higher market share 5 years after it closing a deal than it did at the time of the combination on a pro forma basis. And that is to say we're disciplined. We don't do things unless we believe that we can operate as a combined company and be better. And that really is going to be the focus for us now, is move through the shock of the communication that's inevitable for both companies, get focused on the actions we need to take to ensure that we deliver the financial outcomes, and start the investment, because the opportunities for Comerica's unique capabilities and for ours across this combined platform are things that we could live on for years.
All right, Tim, thank you so much for joining after the announcement. A busy day ahead of you, I am sure. Tim Spence of Fifth Third Bank, after their announcement, $10.9 billion deal to buy Comerica. All right, happening elsewhere right now, Bloomberg's Francine Lacqua is speaking to former ECB President Mario Draghi at Citadel's Future of Global Markets conference in New York. Later, she'll also sit down with Citadel founder and CEO Ken Griffin. That's at 4:30 p.m. New York time. Conversations you don't want to miss. You can watch them on Live Go on your Bloomberg terminal. You're watching Bloomberg Open Interest. Less than 5 minutes until the start of cash equity trading, headed for another record high, up 1/3% for the S&P. The Nasdaq up 0.8%. That thing is off like a rocket after OpenAI agreeing to another deal with AMD. OpenAI has agreed to so many deals with public companies, be it Oracle, be it Nvidia, things that have seen their stock take off. Oh, add CoreWeave into that, but the question is, how do they afford all this? Committing $1 trillion and a half so far this year. Even so, we are still looking at stocks going higher. Russell 2000 up 0.7%. Coming up, we have your opening bell, and Empower's Marta Norton saying it could be time for some profit taking as the AI trade gets frothy. That's coming up. This is Bloomberg. Just seconds away from your opening bell. You are watching Bloomberg Open Interest. I'm Dani Berger. 32 record highs this year. Is that what we're headed for? And it continues to be really just slimly led by the chip makers. After that AMD and OpenAI announcement, you can see the Nasdaq easily outperforming, up 0.9%. The S&P 500 goes up by another 0.4, with gold, Bitcoin, apparently Pokemon cards, apparently everything is hitting a record. Over at the New York Stock Exchange, we have PJT celebrating 10 years of being publicly listed. There you go, PJT himself up there at the podium, Paul J. Taubman ringing the opening bell. You definitely have a kind of a financial services feel to the bell ringing this morning, because you've got Capital Southwest down over at the NASDAQ. They are a publicly listed BDC, a private equity company, and they all seem very happy about ringing the opening bell. And most people should be happy if you're bullish about the opening bell this morning because of this company. Thank you, AMD, for the big tech rally that we're witnessing this morning, up 35% here at the opening minutes of the cash equity trade. OpenAI and AMD have signed a data center deal that could lead OpenAI to get nearly 10% of the chip maker. AMD expects the deal to lead to tens of billions of dollars in revenue. So the gains keep on coming for tech, for this stock market. And we've seen Goldman Sachs and Morgan Stanley strategists both out with bullish calls overnight. Goldman's David Kostin says that companies have a low bar for the upcoming earnings, with consensus estimates, quote, too conservative in light of economic data during the quarter. Meanwhile, Morgan Stanley's Mike Wilson sees potential return of U.S. inflation as boosting companies' pricing power and therefore a boon for their earnings in 2026. Let's bring in another expert view to the conversation. Empower Chief Investment Strategist Marta Norton joins us now. Martin, I should say it's not just them two. It's also Yardeni going back to 7K for his year-end target. Julian Emanuel at Evercore says that we could get a bubble of 9,000 price target for the S&P 500. Are you joining in on these ever increasingly more bullish calls?
Well, I can certainly understand the enthusiasm. I mean, what we've seen from an earnings perspective, really localized in the tech space, and of course related to the AI trade, is strength upon strength. And a lot of that relates to just this untethered belief in where AI is going to take us. And so we see these huge CapEx spends, the deal making within the AI space, including the US government. And when you take a look at just kind of the earnings momentum, you even see analysts upgrading earnings estimates as we head into Q3, which isn't a typical activity. There really does seem to be some momentum there. You have the One Big Beautiful Bill Act, the 100% expensing that comes from that. You have the deregulation theme, which of course could be spurring activity in the finance area of things. So I think there's a lot of momentum. The trouble is how much do valuations express that already? And when you take a look at where they sit, they're at pretty extreme levels.
It's a great point. And just sitting on tech for a moment, too, just the announcements that we've gotten. Let's just take today's with a huge deal between OpenAI and AMD. It also comes off the back of OpenAI committing capital to CoreWeave, to Oracle, to NVIDIA, to Stargate. We are talking about over $1 trillion. And Marta, we don't know where that money is coming from, yet we are bidding up all the public companies that are involved. Is there a degree to which we are just buying now, asking questions later, and that could lead to pain down the road?
There's no question that there's a buy now, ask questions later. There's almost this momentum on its own just from the competitive force moving into AI. No one wants to be left behind. And so everyone's kind of trying to outpace the spend of their competitors, and deal makings across kind of producers, suppliers, buyers. So it's a real incestuous bid war at this moment. I think the question that we have to ask is, I think most of us look at AI and think this is a transformative technology. This is innovation at its finest, and it's going to change the US economy, but that doesn't mean it's a straight line higher. There will be fits and starts, and we had a taste of that with DeepSeek earlier this year, and how much that can really prick enthusiasm and cause for a pullback. So if I'm looking into the AI space, I think I'm looking more for those pullbacks and looking to invest at those moments rather than trying to chase the momentum.
I was going to say, what do you do when you see something like this unfolding, that there is some serious momentum power going up? And even things for just trying to hedge the overall S&P, you have seen some pickup in options there. But Marta, considering we keep hitting record high after record high, it gets painful to try to hedge that. So what do you do to give yourself a little bit of protection as you get a little bit nervous about where valuations stand?
Well, I think one thing that value investors have gotten wrong repeatedly is this desire to time the market, is to kind of pull out and out of these areas that are so incredible from a fundamental perspective. But I do think people can take on a bit of risk management by profit taking as things move away from, the targets that they've established in their portfolios, pulling those back to target, allocating again to those areas that have been forgotten. And I think one thing that is lost in moments of euphoria like this is that the AI trade ultimately should benefit the broader economy. So when we look at some of these, forgotten sectors, and I know healthcare has had a little bit of momentum more recently, but broadly speaking, it has been left behind. AI should be a benefit for that area of the economy as well. So we don't just have to localize all of our AI exposure within the AI names themselves.
But other parts of this economy, Marta, I'm assuming won't do better for AI, and they might even do worse. There's been this real conversation, Neil Dutta has been great at leading this, that it's going to make power and energy more expensive. So everyday consumers are all of a sudden looking at a higher energy bill. Can you, at the same time, see a better economy, but a more K-shaped economy, and maybe not be as enthusiastic about some of those consumer, especially lower-end consumer-exposed equities?
Well, I think that's a very fair point. I think when we take a look at the economy broadly, and this relates to AI, but it also relates more to the economic moment that we're in, it looks to be a bit splintering. So you can look at that from AI's impact on the labor market. There are certain areas that seem, to stand to benefit from AI workflows and from the AI build. And then there are areas that seem to stand to be at the losing end of those things, entry-level jobs that are being removed and that kind of thing. But you see that also with housing. You see that also with the low-income and the high-income consumer. So I do think that there has to be a little bit of, circumspect investing as we're taking a look at this. And we see this with earnings too. There are certain areas of, the sectors of the U.S. economy that are not really seeing their earnings accelerate. So I think some of those consumer names are a good example of those maybe more fraught areas.
How are you thinking about gold, Marta? Up 50% year to date at 3,900. It's a level I think we would have thought would be crazy to reach if we were to have this discussion last year, but here we are.
It's so interesting because as stocks are powering higher, we're also seeing gold power higher. And I think many of us think of those two things as polarized. I think one thing that's really interesting for gold investors is just to remember how much technicals drive this market. We first started seeing gold make its move as central bankers several years ago started moving in more aggressively, diversifying and maybe moving away from the US dollar exposure. And those technicals are starting to fuel institutional investors and individual investors moving into the space. And I think there's also that question around the Federal Reserve, concerns about inflation, concerns about government debt, all of those narratives coming together, pushing gold higher. But what I come back to is, gold might be a great way to preserve capital, but is it a way to grow wealth? And I think that question is a bit less supported by historical evidence.
All right, Marta, really great to get your thoughts this morning. Please come back and join us again soon, Empower Chief Investment Strategist Marta Norton. And as Marta and I were discussing, it is tech. Thank you, tech. Thank you, AMD. Thank you, OpenAI, that is leading this market higher. We're up 1/3 of 1%, pretty even in terms of gainers and losers. You don't need me to tell you what is leading this market higher. It's, of course, AMD. After that deal with OpenAI about building more data centers, more AI infrastructure, they say it will lead to tens of billions in dollars. Tesla's up there too. Wouldn't it be nice to be a company and you could just tweet a picture of a rotating hubcap and you gain nearly 3%? I think maybe Elon Musk has that luxury, which is exactly what happened. People are excited about some sort of deal tease that he maybe has done through that. NVIDIA leading the top of the pile in terms of things moving this equity market down. Does it face more competition for AMD, or does it just mean the money that was promised to them from OpenAI, where does it even come from? Where does OpenAI get over $1 trillion in the capital commitments that it has promised? Looking at the sectors this morning, too, it is, of course, tech at the top of the pile, too. That's up 0.7%, followed by utilities. Again, you could say, hey, it's a safety sector, but utilities, again, also really benefits off of the AI data center build out, too, followed by industrials and energy. Oil is moving higher this morning at the same time. At the bottom, you have communications and then consumer staples. It's a really tough day for the likes of Pepsi, of Campbell, a lot of those really brand name consumer stocks feeling the challenge this morning. Okay, coming up, we're going to get more on the thing moving the market this morning, and that is AMD's new deal with OpenAI. It could send chip revenue soaring in the coming quarters. We have the details. That's up next on Bloomberg Open Interest. Let's get you some top calls. Some of the analyst action that we are watching this morning. First, Ford gets an upgrade over at Jefferies. Jefferies analysts saying that the automaker could see some improvement in earnings and may benefit from its EV strategy shift. Even so, shares are down 0.4% this morning. Next up, Boston Beer gets a downgrade at Citi. Analysts say that the makers of Sam Adams beer saw weak demand this summer and cites a challenging backdrop in the second half of the year thanks to tariffs and the price of aluminum, those shares down just under 4%. Finally, Micron, that gets upgraded to a buy at Morgan Stanley. Analysts there say the chip maker is headed for multiple quarters of double-digit price increases, and even though valuation might be a worry, they still will retain pricing power. Those shares up 6.33%. Let's stay on chips because it is yet again powering this market higher. OpenAI's latest deal is with AMD, and it could help AMD's AI chip revenue jump from under $7 billion in 2025 to more than $100 billion in the near future. Bloomberg Tech co-host Caroline Hyde joins us now. Caroline, what exactly is AMD, and is OpenAI getting out of this deal?
Another creative bit of financing, because we've got so much compute that's necessary. How are they going to finance this? This time, remember, we were talking about $100 billion deal of NVIDIA taking OpenAI equity. This time, OpenAI is taking equity in AMD, but under warrant form. So they have to meet certain milestones in terms of the amount of GPUs. Particularly, it seems as though the reporting goes that it's being used for inference, and as much, we'll dig into that with Lisa Su and Greg Brockman of OpenAI a bit more later in the show. But broadly, you're seeing both of them benefit from the relationship with each other. OpenAI, of course, gets access to GPU that isn't just NVIDIA's, and they're able to train their models and satiate all of our demand to use ChatGPT and what we're using in enterprise as well. but they also get upside in AMD's own share price rally. If we see them going up to, at some point, $600 per share, that would mean you've got about $1 trillion market cap, up from what is currently $350 billion. Well, they get to benefit in that and buying it basically at a penny. Then on the other side, AMD is going to be benefiting from basically OpenAI anointing them as the key player other than NVIDIA. The fact that their GPUs are going to be used to help all of our demands for generative AI, they're almost getting anointed as, we like your stuff, we like your tech, you can grow into this. So AMD's gets OpenAI as a clear, dedicated demand source for the next however many years that they run out to give these 6 gigawatts. I mean, that's the whole of Massachusetts, like energy demand in a year, 6 gigawatts of power.
I know this is incredibly simplifying it, but just listening to you describe it, it almost feels like OpenAI is running like a hedge fund or an investment fund, just like putting out a bunch of different bets and saying, hopefully some of these will work out.
But it depends who's getting bets from who as well.
True.
I mean, usually it was NVIDIA that had all the chips here, pardon the pun, but they were like the ones that were at the table being able to like dole out who I'm going to be putting money into and how I'm going to pay my future demand source to use my GPUs. Now AMD's having to get creative as well, but more they're having to share in the upside of their own share price rally with those that are going to be demanding their GPUs in the future. But it really does feel like bankers out there and the executives, the C-suite of these businesses having to get ever more creative, because where is the money coming from for all of this? And that's the key question. How is OpenAI going to ultimately be affording 6 gigawatt necessities of GPUs? Interestingly, though, the GPUs from AMD could be coming directly from Source, but also via their cloud partners as well. Remember, they have a $300 billion deal with Oracle to provide cloud. Maybe Oracle could be buying some AMD chips, not just NVIDIA.
Well, it's not just how do they afford this deal itself, where does the money come from? It's also what CoreWeave, Oracle, you're looking at some of those deals that we had there. What is it, like over $1 trillion now we must be talking about that OpenAI is committed. That is a lot of cash that they need to put to work.
And that's where we saw at that time last month, Oracle and OpenAI in Texas at their key thus far data center that they put in the ground, but their promise is to scale this into other states, more in Texas, more in Ohio, more in middle America. And yes, this desire from Sam Altman to say this is going to be $1 trillion of compute, at least, that we're going to need, but we're all going to rise together. Look, there's a lot of hope, there's a lot of prayer, but there's a lot of demand that needs to be satiated. And basically, everyone has to bet that together we're going to build the compute, build the infrastructure, and then be able to get the productivity outcome. But we need more proof in the productivity and the revenue run rates for companies like OpenAI.
I guess to what degree is this a wave that lifts all boats? Because immediately after the deal was announced, you saw NVIDIA fall, for example, Intel fell. Is it a problem for competition, or just the plethora of money that's being promised mean that this is an environment where all of these chip makers can do well?
I think NVIDIA's, it's only down a percentage point or so, and I think there is a case that, at the moment it has about 70% of market share. It's never going to be able to bring all of its GPUs to absolutely everyone. They need other players in there. And look, you have OpenAI already saying, look, we're going to be building our own chips with Broadcom. We've had hints of this, that basically there are going to be other players in the game. The key question now for Lisa Su is how much market share can she take? How much can she scale into this moment with her own GPU and AI accelerators? Because at the moment, she's been a very far distant second. Can she start to make waves?
And we can't wait for your conversation with her. Really looking forward to that, Caroline. Thank you so much for joining. That is Caroline Hyde of Bloomberg Tech. And again, don't miss her conversation alongside Ed Ludlow, 11 a.m. with AMD CEO Lisa Su and OpenAI President Greg Brockman. That will happen, again, Bloomberg Tech, a conversation you don't want to miss. Coming up on this show, Verizon names its new CEO. We'll have the breakdown for you next as shares fall nearly 2%. That's coming up next. Twenty minutes into your cash equity trade, you're watching Bloomberg Open Interest. Will we get another day of another record? This is getting repetitive, isn't it? It's not only another record, it's another government shutdown, but who cares? Stock's up 0.1%. We are losing some of the steam across markets, but tech is still outperforming, up 0.6% for the NASDAQ. The Russell 2000 hit its second record high of the year on Friday. Is today a third? And again, it's chip stocks. This continues to be the story of the past month year, really. The Philadelphia Semiconductor Index up 0.4%. Gold, that's also at another record at just under 4,000, up 50% year to date. Looking at some of the other things, Nvidia, that moves lower. Again, maybe more competition from AMD. AMD shares up 29% off the back of that deal. Stellantis agreeing a $10 billion investment in the U.S. That's a big strategy that they are undertaking. Shares not moving a whole lot, but Tesla is, because Elon Musk tweeted out a video of a rotating hubcap, and we get all excited. Okay, is there going to be some sort of product launch coming to market? The telecom company is having a rough day of it. AT&T down 2%, with Verizon shares falling 1.6%. But let's stay on that story, because Verizon announcing a new CEO. We are joined now by Bloomberg Intelligence senior telecom analyst John Butler. John, that announcement coming in the early hours of this morning. Why the change? What's going on there?
So my sense is that Verizon is looking for answers for its growth problem. They really have trailed AT&T and Verizon for several quarters, actually a couple of years now. And they've made a lot of moves, taken a lot of action to try and course correct here and go from share donor to share gainer in that postpaid wireless business, the contract business. And it just hasn't worked. And I think they're looking for change here. And so they named the head of the board, Dan Schulman, to be CEO. And Dan has a background as CEO of Virgin Mobile. He also worked at AT&T for almost 20 years. So, the thought hopefully here is that Dan brings in a fresh perspective.
Yeah, but shares are off this morning, John. Is that just a factor of changes to come, or is there something behind it that investors are less enthused that this can be a welcome change?
I think the big surprise to the street was the fact that Sam Path, who's head of the consumer unit and who was being groomed for the CEO spot here for a couple of years now, didn't get named CEO. I was really shocked at this news. I thought Sam Path would be named CEO somewhere in the next 6 months here. He's a young guy, brings great energy to the consumer group. But again, all the actions they've taken have yet to work to really turn around growth there. And I think the board looked at it and said, he's a dynamic personality, but the report card is still not great here. So let's try bringing in someone who has outside perspective. And I'd note one thing, by the way, Schulman has executive experience at American Express and PayPal. And so my sense is Verizon may begin to test some adjacent markets like consumer finance as a way of jump-starting growth here in coming years.
That could be interesting. Is there a model that echoes that they could look to that's been successful of some of these other telecom operators, John?
So the one example that jumps out, I was thinking about this in the wake of the news, is T-Mobile is moving into the outdoor advertising market. And so far, so good there. I think what's interesting is if you look at outdoor advertising, it's almost or even in excess of a double-digit growth market. And I think that's probably what's needed down the road for all telecoms to begin to edge out of that core consumer wireless business. And make no mistake, by the way, consumer wireless is consumer retailing. It's very similar to what you might see with the specialty retailers. They have thousands of retail stores. They advertise during sporting events. They run promotions. That kind of behavior, I think, would carry well over into some market adjacencies that are consumer-facing as well.
Yeah, and John, it's a great point, especially given some of the tension in consumer sectors right now, the changes that need to be undergone. Thank you so much for joining us, Bloomberg Intelligence senior telecoms analyst John Butler, off the back of an announcement of a new CEO at Verizon. Coming up in the next hour, HSBC's Racquel Oden says the government shutdown is historically good for stocks. Does history play out again? Plus, we talk space exploration and NASA's Mars mission with Voyager CEO Dylan Taylor. You're watching Bloomberg Open Interest on a day where we head to another day of record highs on this equity market. 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is off. We're losing some of the steam that we had in the pre-market session, but stocks are still trading higher after hitting their 31st record high on Friday. Coming up, OpenAI strikes again, inking a deal with AMD that's been sending shockwaves and some big gains through the chip industry. AMD up 26%. Meanwhile, Fifth Third scoops up Comerica for nearly $11 billion. It is the biggest U.S. bank deal of this year. Plus, gold and Bitcoin are powering higher as investors react to surprises in Japan and France, as well as ongoing gridlock in Washington, D.C. And we begin with stocks on a 7-day winning streak. I caught up with Marta Norton of Empower earlier on her outlook for equities.
What we've seen from an earnings perspective, really localized in the tech space, and of course related to the AI trade, is strength upon strength. And a lot of that relates to just this untethered belief in where AI is going to take us. And so we see these huge CapEx spends, the deal making within the AI space. There's a lot of momentum. The trouble is how much do valuations express that already? And when you take a look at where they sit, they're at pretty extreme levels.
Let's continue the conversation with Racquel, Oden, HSBC's head of wealth and private banking. Racquel, wonderful to see you this morning. And there's a lot of optimism out there, but it's an equity market that's been being driven by tech, by expectations for earnings. It's notably not being driven by a 6th day of a government shutdown. Are we being complacent, or is that the right thing to do here?
Well, I think what we realize here, the importance of government employees, right? So if you think about our government, 750,000 people, where if that were to ever hit the unemployment rate, it would go from 4.3 to 4.8. So it is clearly a very impactful thing if this government shutdown were to stay for an extended period of time. I think all of us are going to this pretty hopeful that it won't be for an extended period of time, but we also know that it would slow growth. It actually impact GDP as well as inflation. Inflation already hovering at 2.9%. It would definitely be moving it up to 3%. One of the things I think is kind of important that the market is pricing in this, what I call shutdown a little bit. If you look at MSCI, which is the world index, and you compare that to the US S&P, we've always outperformed the MSCI world index. Right now, the S&P is not outperforming that because they're pricing in this shutdown. Now, post-shutdown, I am optimistic about what that means for equity markets and what it means for growth overall. But in the short term, lots of volatility. And we always know September, October generally are the slowest months in the market. But this October, with the shutdown, actually is making it a little bit even more lagging.
Past shutdowns, you've done some really excellent work just showing stocks actually typically rally post a shutdown. So you're talking about this time might be different given if there are layoffs, but I wonder if this time is different also just because we're coming from a more fragile place. With consumer sentiment already a little bit more fragile, does it have an outsized impact on, for example, government workers' willingness to spend after the outcome of this government shutdown?
So you're absolutely right. So what this actually does is increase our predictability of there being a rate cut for that reason, as you just stated, right? So we're talking about a second cut in October.
Which really could also be good for stocks.
Good for stocks, as well as another cut in November. So 2 more rate cuts starts to answer that question, right, about the consumer and how they're feeling. And as part of that, it's really important is what we have seen, though, is strong corporate earnings, right? So right now for third quarter, we're at 8% earnings. We're predicting by the end of the year, 11% corporate earnings. And for next year, at 14% corporate earnings. So if you think about corporate earnings being strong, we're going to get this interest rate cut, stock market at an all-time high, one would say that is a very healthy market. And what I'd say is you're starting to see a little bit of that today. It starts opening back up IPOs, right, as a standpoint, and M&A activity. You talked about 2 already that happened today. So we're going to be cash rich in the standpoint also with the corporate tax cut that was unexpected that's now being priced in for fourth quarter. I would tell you, quite honestly, equity markets very bullish for the second half of the year.
It's not just equity markets that are at all-time highs. You mentioned world indexes too, but it's also things like gold. Bitcoin is trading at an all-time high. There was one analyst talking to Bloomberg, and apparently Pokemon cards are trading at an all-time high, which I'm sure you're not recommending your clients to go out and buy. No, but even so, how much of these other pockets and corners of financial markets is about fear of what's happening in government? It's not just the U.S., but you have turmoil in France, changes to Japanese government leadership. How much of this is just looking beyond sovereign bonds and finding other corners to hide out in?
Yes, so we actually have a report that came out, the World Entrepreneurial Report, that talks about that, where diversification is not just diversification within your portfolio, but diversifying in other international markets. For the U.S., the number one destination right now is the U.K. and Canada, obviously closest to us, and Switzerland are the top three for U.S. assets going into other markets for wealth accumulation. The number one destination globally, we actually interviewed 3,000 global entrepreneurs across 15 countries. Number one destination right now is Singapore. The U.S. dropped rankings to number 4. We were higher on the rankings. So where people are diversifying their assets around the globe is really important, and we're seeing the behavior. But the good news about that report, it also talked about the entrepreneurs, global wealth entrepreneurs are 95% optimistic about the markets. And that is purely because of technology, AI, and innovation.
Why wouldn't that lead to more of an overweight in the U.S.? Because this is where a lot of the deal announcements are happening. A lot in China maybe as well, but UK, I mean...
Yeah. So I'm going to go back to my short-term, long-term.
Yeah.
In the short term, with all this market volatility, there's still tariffs that hasn't been resolved yet, November 9th, right? So all of that is causing like a little less investment in the U.S., but long-term, those dollars are coming back just like the equity markets I told you are coming back because of our corporate earnings. So it's a short-term dip with obviously a predictability. In the long term, the dollars will be coming back to the U.S.
In the long term, though, some of these commitments that OpenAI, let's just take them because they have the deal news with AMD today, they are really, really weighty. They're talking about billions of dollars, hundreds in some cases, with individual companies. All of that adds up to trillions. And there's this weird question of where this money comes from. But even so, we're buying now, asking questions later. Is that the right way to approach this? Or will at some point the rubber meets the road and these commitments maybe can't fully come to fruition?
So here's what I would say. Normally, if you're just looking at data and statistically, one would say that. But quite honestly, we have to believe in the fact that the AI tech revolution is just starting. So I really can't cap the exuberance to say that we can expect this to slow down next year, right? Over the next couple of years, things will change, but you've got to realize we're just at the beginning of what I call this tech innovation revolution. And AI has, as you just saw today, OpenAI purchasing AMD was a huge statement because you're using chip manufacturers, now going with the OpenAI. The possibilities are still endless.
Do you just ride the winners that have already existed, or are you looking underneath, looking for maybe other picks and shovels or other related utilities or other beneficiaries, which probably have done well? Because I don't know if you can find corners that are really undervalued, but maybe not as well as like the NVIDIAs, AMDs of the world.
I've covered this before, but I'd say in the standpoint, the Mag 7, I do believe valuation's pretty high, right? But there's this wonderful group called the Forgotten 493. They're not so forgotten. If you look at our predictions for that 493, that is where you're going to see the massive growth, and that's where I'd say there's been undervaluation and opportunity that absolutely still exists out there.
Do you like small caps? They've finally hit another record with the rest of this market.
I like a lot of things in the market. I think what we're seeing here right now.
Don't like actually? Maybe that's the better question if you like a lot of things.
So what I did say, what I don't like right now is the short-term volatility that we're going to experience, right? So I would say go in cautiously. If I think about the industries that are going to do extremely well, and that is my long-term push, which would be tech, financials, and industrials for the things that we just talked about, right? You've got to be actively engaged and obviously look at which sectors are going to be impacted by the different things that we're talking about here. But ultimately, you know, equity, bullish, and next quarter, as we look at the earnings, will continue to look pretty strong fundamentals.
Racquel, this has been so great. You have to come back again soon. This was really excellent. Wonderful to speak with you. That's, of course, Racquel Oden of HSBC. Let's get a quick check on your markets this morning, 40 minutes into your trading day. And you are looking at a Russell 2000 that is trading near all-time highs yet again, and an S&P just barely hanging on to gains, but a tech sector which is leading those gains. 10-year yields are higher by 1.7 basis points. Maybe that's why you see some of the stress coming through to equity markets, but it had been mostly rallying treasuries last week after some weaker payrolls data. It is the 6th day of a government shutdown. When will markets care? Racquel Oden talking about some of the circumstances that might mean that this time is different, especially if we get layoffs amid a fragile market. Some of the individual stocks, though, that are moving this hour. Fifth Third agreeing to buy Comerica for about $10.9 billion in stock. It is the biggest U.S. banking deal this year. That agreement will create the 9th largest bank in the country. The CEO, Tim Spence, was speaking to us in the last hour, saying the regulatory environment has gotten easier for them. And but they are positive, or at least confident they still would have been able to do this deal, even if it was under the Biden White House. Elsewhere, Boeing has told its suppliers that it could hike 737 MAX output as soon as this month, shares up 0.5%. Sources tell us that the company also has plans to increase the manufacturing pace 2 more times, eventually getting to 53 per month output by the end of next year. So have they finally wrestled control back of their factory process? Meanwhile, Tesla is leading the Mag 7 higher. The move coming after EV maker teased a product announcement in a series of cryptic social media posts. Elon Musk tweeting posting, Xing, whatever it's called, a rotating hubcap with a Tesla logo on it, and that's good enough for a 2.5% rally. Coming up, we get back to the big deal this morning. AMD signing a data center deal with OpenAI worth tens of billions of dollars. We're going to dig into the details. That's coming up next on Bloomberg Open Interest. Some high interest stories, a look at what's making headlines around the world. France's political crisis deepened today as Prime Minister Sébastien Lecornu quit after just 1 day after Macron reshuffled the cabinet, citing an unworkable parliament. That surprise sent French stocks tumbling and bond yields climbing. Lecornu's exit, the third collapse in under a year, leaves Macron scrambling to form a new government, call elections, or risk paralysis just days before a budget deadline. And Illinois is suing the Trump administration over its plans to deploy the National Guard troops to Chicago. That challenges the president's authority to use soldiers in response to protests over his immigration crackdown. The White House has already deployed the National Guard to cities like LA, DC, and Memphis, Tennessee. Meanwhile, a federal judge in Portland is blocking President Trump from sending National Guard troops to Oregon. They accused his administration of trying to dodge an earlier court order. The 14-day ruling will put a stop on the administration's plans to deploy hundreds of troops from California and Texas amid protests. Again, those protests happening against Trump's immigration crackdown. Meanwhile, one of our top stories this morning, AMD stock soaring up 22%, a massive deal with OpenAI to power its AI empire. OpenAI will use AMD chips for years to come, potentially bringing in tens of billions of dollars for the chip maker. The Pact gives OpenAI a chance to own a slice of AMD if things go well, marking a bold challenge to NVIDIA and another sign that the AI gold rush is still running hot. Let's get more on that deal with Bloomberg Intelligence Global Head of Tech Coverage, Mandeep Singh. Mandeep, I mean, it is a warrant, right? Like, they're not necessarily taking a position in AMD unless things go right. Does that kind of show us, I don't know, the hierarchy of some of these chip makers, the fact that this is the way this is being structured?
Look, right now, I think the focus for OpenAI is how to scale their revenue to their $200 billion target that they have given by 2030. And it sounds like, unlike the prior, software build-outs where you had companies with incremental margins of 90%, with generative AI, you need compute. Even though they will scale to $200 billion in revenue, that doesn't mean their margins will dramatically improve. They need the chip build-out. They need chips from every company that's selling them, NVIDIA, Broadcom, AMD. And they're showing that, diversification is the right strategy as they look beyond, the next 3 or 4 years. Because if they're just reliant on NVIDIA, I mean, guess what? You're always at the mercy of NVIDIA giving you chips. And that's the playbook here, is to diversify your supplier base.
How strained does it make the supply chain with diversification if OpenAI is no longer just looking to NVIDIA, but basically everywhere trying to hoover up every chip in existence?
I mean, they did that with Microsoft. Remember, they only deployed it on Microsoft Cloud. Now they have that $300 billion deal with Oracle. You have to figure out, how does OpenAI pay for all of that? So one, they made NVIDIA pay to OpenAI, and now it looks like they're taking somewhat of a stake in AMD. And look,
surely that's not enough, Mandeep.
The optics don't look great, but at the same time, one thing is very clear, is this software is quite expensive, and your customers have to pay up for it, and you have to pay up for it to build out that infrastructure.
Okay, but just a stake in AMD and NVIDIA giving you some money. I mean, we're talking about OpenAI committing, what is it, like $1.5 trillion in just what's been announced so far this year? Surely that doesn't get them there.
Yes, I mean, look, at the end of the day, not everything will be clear, so you have to rely on the companies with the best balance sheets. So it's your hyperscalers and also NVIDIA with the build out that they have had so far, the 75% gross margins. They have the best balance sheets, so they can pay up for a lot of this build out themselves. And you somehow have to figure out how much debt companies can raise and how much of their own balance sheet they're going to use. But like I said, the incremental margins are not the same as traditional software, and that is what is so different about this cycle.
Well, Oracle, one of the companies that very publicly tapped the debt market with no problems. But Mandeep, you've been covering these companies for such a long time. They are usually asset light, and they usually don't carry with them huge amounts of debt on their balance sheet. Just how different of beasts are you looking at analyzing now, just given their changing structure?
Yeah, just think about the upfront capex investment involved. And what is the incremental revenue being generated? And right now, the gap is so huge in terms of the incremental revenue versus capex. To my mind, at some point, it has to flip. Otherwise, companies will curtail their capex. Whether that's 12 months down the line or 24 months, that's the question that we are all grappling with. But clearly, you want to see that incremental revenue catch up to the capex being spent. Otherwise, there will be a big, I think, slowdown.
Are they talking about that when that period will happen? Or are they like, don't pay attention, don't look here, don't pay attention to the man behind the curtain, keep buying our equity?
I mean, the good thing is use cases keep showing up. So that coding agent market would be close to a $50 billion market now, given so many companies have started using it. We know chatbot, ChatGPT subscriptions has done quite well as a separate subscription. So I feel as long as the use cases are there, like people are willing to give it more time. But the numbers are getting so big now that at some point you have to ask yourself, okay, when will the incremental revenue actually surpass the capex involved? Because the capex numbers are also growing at 20, 30%. So I think the equation is getting harder and harder. But you just have to wait for when that air pocket will arrive, which I do think will arrive in the next 12 to 24 months.
All right, Mandeep, thank you so much for joining. Another day, another deal. I'm sure you'll be back probably like tomorrow or the next day about some other AI infrastructure deal that's happening. Mandeep Singh of Bloomberg Intelligence, thank you so much. And you can hear more about this deal in the next hour. Bloomberg Tech will be joined by Lisa Su, the AMD CEO, and Greg Brockman, the OpenAI president. Still ahead on Bloomberg Open Interest, the IPO revival is in limbo as the U.S. government shutdown drags on. We'll discuss the impact to capital markets. That's coming up next on Bloomberg Open Interest. The U.S. government shutdown is leaving IPOs in limbo, with the limbo as the SEC remains largely closed. That puts billions of dollars worth of deals on hold. Joining us now is Anthony Hughes, Bloomberg Equity Capital Markets reporter. Anthony, what exactly is the mechanism here that companies who are about to IPO or want to can't do because of the government shutdown?
Yes, so for companies to go public, they really need the SEC to be open for business, because the SEC's reviewers look at the prospectuses or the registration statements of these companies, and they make them effective, which is the word that they use, which basically allows these IPOs to proceed. And what we've seen is that in recent weeks there's a couple of IPOs that were already on the road before the shutdown began, and they got early effectiveness. So we will see a couple of IPOs price this week, but there are definitely a few others that were lined up to launch this week and to price in the coming weeks, and they're somewhat in limbo. They haven't launched, so they'll have to wait until they'll have to wait till the shutdown ends, basically, before they can proceed.
It's still, capital markets are so incredibly hot right now, and every corner you look at, will this have any dampening impact, or is this just simply a delay?
Well, the big question is how long this shutdown lasts, and I think that's going to be, a tough question for everyone to answer at this point. So if the shutdown really drags on for beyond a few weeks, I think a lot of people who are looking to go public this year will just say, let's just wait till next year, and that might be okay. I mean, I think obviously the IPO market's had a lot of momentum this year, and certainly in recent months, and it's disappointing for the bankers that they can't proceed with these IPOs, but it's been a fairly this time of year also is can be challenging because of the calendar. So in some ways, the last few months of the year is not always a perfect time to go public anyway. So, there's pros and cons, I guess.
Could it be different this year, though, just because there are so many companies who came into the start of 2025 ready to IPO?
Yeah.
And then we got the tariff turmoil, and that put everything on ice. Do you then expect a more active back half of this year, or I guess last quarter that we're in now of this year, just because so many were delayed to start?
Yeah, well, I think we certainly were expecting the IPO market to be pretty busy, certainly relative to last year, certainly showing a good increase from last year. But, really sort of the cadence of perhaps, three or four IPOs a week in the weeks that are available to go public in, but then having all these public holidays and calendar issues, which mean there are a few weeks in the later months of the year where you can't really go public in anyway, so.
Well, some of these companies that have been able, again, we're already on the road and already proceeding with their IPO. I mean, University of Phoenix
Yes.
being one of them, that seems like kind of a surprise that this is a company that there'd be appetite for in public markets.
Well, it's interesting because a lot of the hot IPOs we've talked about this year have been really in sort of fintech or crypto, but this is what we call a sponsor-backed company, a company that's a leveraged company owned by private equity, and we haven't seen too many of those, and they tend to be tougher sells. And this one's coming at a relatively low multiple, which is perhaps the compensation for the fact that, this is not a business which everyone's going to love. So, it'll often, all of these IPOs come down to valuation and what makes an attractive valuation. But I think bankers certainly have the view that they can pretty much get everything done at the moment. It's just a question of price, right?
All right. Thank you so much for joining us, Anthony. That is Bloomberg's Anthony Hughes on a day where we're not likely to get many IPOs, or week rather, as the government shutdown drags on. A quick check on markets. About an hour into your cash equity trade, we are 0.2% higher for the S&P, 0.6 for the NASDAQ, thanks to a rally in tech, with yields moving higher by 2 basis points. Coming up, AI is changing how things work on Earth, but how about outer space? We speak to Dylan Taylor, Voyager chairman and CEO. That's coming up next. You're watching Bloomberg TV. Checking in on one of this year's hot IPOs, Voyager went public back in June. The stock is above its $31 IPO price, but the stock is down from its earlier trading pop. All of that comes as Voyager pushes forward with its AI-enabled space station, Starlab. Joining us now is Dylan Taylor, Voyager chairman and CEO. Dylan, great to speak with you this morning. The ISS, it is this iconic thing that when people think about progress of American space and global space, it is front and center in the conversation. NASA is phasing it out. What is your role in that transition?
Yeah, so as you said, the ISS will be decommissioned right around 2030 or so. And so NASA intends to utilize commercial space stations going forward. So we were honored to be one of the phase 1 winners of the space station program. There will be a phase 2 awarded sometime early in 2026.
The shift, no doubt, has been moving more towards private sector space engineering and space innovation away from public sector. Dylan, how do you see that transition continuing and that mix of the two?
Yeah, so, this has happened before, actually, when we had the space shuttle in the mid-90s and that program was canceled. There was a new program that was created called Commercial Cargo and Commercial Crew. And in fact, that's what gave birth to SpaceX, right? The whole privatization of rocketry in sending both cargo and humans to space. So this has been used in the past. And basically, you're turning the model, inverting the model from owner-operator to commercial activities that the government's using as a service. So it's actually a successful model that's been used in the past, and now it's being applied to space stations and destinations in low Earth orbit.
The administration's budget, though, for 2026, maybe will bring that even further towards the private sector, looking at cutting NASA's overall funding by 24%, including a 47% cut to funding, reducing NASA's workforce by 35%. It takes them back to a budget and a workforce size that it hasn't seen since the 60s. Dylan, is that a problem for overall space advancements for the U.S. if we're looking at those types of budget cuts?
So back to the space station program, even in the president's budget, which is the most, has the highest level of cuts of anything proposed, even more so than the congressional budget, the space station program is very well funded and protected in that. So it really depends on the program, Dani. So for example, SLS, which is the large rocket system, That's quite vulnerable in the president's budget. So depending on what programs you're involved in, it could have an impact. But keep in mind, we have a heavy lift rocket with Starship coming online. So if SLS were to be cut, many would observe that that doesn't necessarily hurt the industry the way you might think, because you have commercial alternatives coming online.
But a lot of those commercial alternatives, again, see NASA as one of their biggest customers, Voyager among them. Does it slow down things if NASA doesn't have the budget it once did?
Again, it depends on where the cuts are coming from. So again, back to the space station program, that's quite well protected. There are a lot of other programs that we're involved in that are quite well protected. So I think it really depends on which programs you're competing for. But at the same time, commercial activities have never been better in terms of the technology and the innovation. As you mentioned, we got public earlier this year. There were a couple other space companies that got public as well. So I'm very bullish on the industry in general. And I think there's a lot that commercial activities can do to contribute to NASA.
What do you think is next in major commercial opportunities, Dylan? I love in your biography, you were the first person to 3D print something in space, which I think is incredibly cool. So is it manufacturing? Is it defense? Is it tourism? What leads this next leg higher in commercial opportunities in orbit?
Yeah, no, it's a great question. I think data centers, ones and zeros, a lot of data processing. There's a huge trend, Dani, towards edge computing. So rather than collect data in space, transmit that data back down to the Earth, put it in a cloud, machine learn it, put AI on it, and transmit the answer to the customer, why not do all that data processing where the data is collected and just transmit the answer? So as you mentioned, Starlab, our commercial space station effort, is AI enabled. We have great partners involved with that activity, including Latent AI and Palantir, amongst many others. And so the whole idea is, how do you actually create a technology stack to process that data in low Earth orbit? So I would anticipate that'll be a big push. You mentioned space manufacturing. You can grow essentially perfect crystals in space in microgravity. So whether that's semiconductors or extruding, perfect crystalline structures for biopharma drugs and the like. There are a lot of activities you can do in low Earth orbit if you actually have the real estate to do it. And that's why these commercial space stations are so important.
Yeah, Dylan, I got to stay on this for a moment, because it is a moment in time, especially when it comes to AI and data centers and the build out there and the infrastructure, that trillions of capital are being committed to this project its very self, from the hyperscalers to OpenAI. Is there a conversation about some of their role in commercial opportunities in space? Have you heard any of them talk about this?
Well, I think Jeff Bezos talked about this a couple weeks ago at a conference, as I recall, talking about 10 to 20 years out before the hyperscalers are building data centers in space cheaper than they can build them on Earth. I think he's on the right track there. I would actually think the timeline's going to be sooner than that. But whether it's cheaper to do a data center in space or not, there's a lot of advantages to having a data center in space. You have unlimited power up there, right? I mean, you have the sun, it's shining 24/7, depending on where you're oriented in orbit. So I think there is promise to do that. Data centers on the moon have been talked about. And just back to the original question you asked, I think low Earth orbit will be commercialized, but certainly the lunar environment will ultimately be commercialized as well. And then, of course, you have people like Elon and others that have deeper space ambitions, including Mars and things like that. So it's a very, very exciting future for the industry.
I can't help but get out of my mind a picture of like Meta's data center next to OpenAI, next to Oracle on the moon. It feels like the stuff of science fiction. Very cool to hear about it, talked about as a near-term future thing. Dylan, thank you so much for joining. That is Dylan Taylor of Voyager. Data centers on the moon. I'm going to have a hard time getting that one out of my head. Let's first get a check on markets, though. We are up 0.2% off to the moon, with the NASDAQ up 0.5% after a deal announced between OpenAI and AMD that would also see OpenAI take a stake in AMD should certain protocols be met. OpenAI gets their chips, and they've been hoovering up chips from everywhere that they can. You're also looking at 10-year yields up 0.2%, but that not hindering this equity rally. Let's get a look at some of the single stocks that are moving this hour. Shares of critical metals rising following a report that the Trump administration officials have been discussing taking a stake in the metal mining company, up nearly 70%. Stellantis, meanwhile, is planning to invest about $10 billion in the U.S. Sources tell Bloomberg that the car maker may announce $5 billion of fresh money in the coming weeks, on top of a similar amount earmarked earlier this year, shares up 1.4%. Meanwhile, Fifth Third agreeing to buy Comerica for about $10.9 billion in stock. It is the biggest U.S. bank deal this year. That agreement will create the 9th largest bank in the country. And in the last hour, I spoke with Fifth Third CEO Tim Spence about the deal.
We've been patient and quite deliberate as it relates to M&A because M&A is disruptive. And it's higher execution risk than the way that you would grow organically. So in order for us to ever be interested, we have to believe that it advances our strategic priorities, that there's enough of a return premium that we can compensate for additional execution risk, and that at the end of the integration process, we're not just going to be bigger, we're also going to be better. And I think this is one of those rare opportunities that meets all those requirements. The return premium on the deal here is a 22% IRR and about 9% earnings per share accretion to Fifth Third shareholders. It's neutral to tangible book value per share at close, meaning no earn back. And those measures are all better than we can achieve purely on an organic basis. And strategically, I'm really excited because the retail franchise is the thing that has really distinguished Fifth Third over the course of the past 4 or 5 years. We've been the fastest growing large bank in the Southeast, the large regional bank in the Southeast during that period of time. And we now get access to Texas as part of our expansion plan. And in Comerica's case, the crown jewel of their company is this is an incredibly strong, disciplined middle market and commercial banking franchise. And I just think the opportunities are so significant to unlock that franchise across the broader combined footprint here. So it's a great opportunity to do it. And I think the window seemed right.
Again, a $10.9 billion deal between Fifth Third and Comerica. You were listening there to the CEO speaking to us earlier. For more on this deal, we are now joined by Herman Chan, Senior Regional Banks Analyst for Bloomberg Intelligence. And Herman, this is one in a string of many regional bank deals that we've seen so far this year. How necessary was this for Fifth Third in order to remain competitive?
Right. So Fifth Third's been really strong about growing into higher growth markets, specifically in the Southeast. This deal for Comerica really is an extension of that, where there will be a much larger presence in areas like California and in Texas. And it really builds upon what Tim mentioned, bigger and also better. So we'll excited to see the growth trajectory of this organization.
And bigger. It is a big deal, and it's something that regulators usually would have taken over a year to really comb through and decide. How different is it going to be this time?
Right. So we can point to what happened most recently last Friday, where Huntington is also in the middle of a merger with a company also in Texas, Veritex, and it's going to take about 98 days for that deal to close. You compare that with under the Biden administration, it took 400 to 600 days for larger bank deals. It's a stark change and really highlights the deregulatory efforts under the Trump administration.
What about Comerica's business? We had a viewer write in asking about Comerica's wealth management business. Where do things stand there?
Yeah, so I think what is happening is that's a supplementary part of the deal. And Comerica and Fifth Third both have wealth management businesses. Fifth Third specifically has talked about wealth management as being a fee income driver for the organization, and the wealth management business for Comerica also supplements this as well.
Comerica also has this interest rate exposure, though.
Right.
And it's something that activists had been pushing them to take care of, to sell themselves, to figure out something. I asked Tim Spence about it, and he basically said, look, they've already been working on right-sizing the balance sheet, not really a concern to us.
Right.
How much work is Fifth Third going to have to do as this combined entity to work through some of those issues?
Yeah. Well, the beauty of bank M&A and merger accounting is that those swaps get marked to market. And so Fifth Third's going to be operating with a clean slate going forward. there was a question on the call with analysts about interest rate risk and positioning going forward, and Fifth Third management had really credible responses about managing their rate exposure, adding more fixed rate assets on top of the variable rate loans that Comerica historically has operated with.
So now Fifth Third goes to $288 billion or so in assets, and that puts them again above this regulatory threshold of $250 billion.
Right.
There were so many banks. Bloomberg, the banking team at Bloomberg News had this great story mapping them out, just showing the concentration right below that threshold for so many banks not wanting to cross it. Now, considering that what we're talking about, the regulatory environment getting easier, is this an environment where we're just going to start to see one after another through M&A leapfrog that regulatory threshold?
Yeah, so that's something that a lot of the banks within that 250 mark, banks like Fifth Third, banks like KeyCorp and Huntington have thought about in the past. And on top of the other deregulatory efforts that we talked about, there may be some deregulation down the road for that threshold size. So that's something that we're looking forward to hearing from the Fed and regulators if that indeed does change.
How much more expensive does it get, though, to cross that threshold?
There's certain aspects that are required to maintain, like harder liquidity metrics and other regulatory hurdles that the banks have to take. But these are metrics that I think the management teams are very well aware of. And given that there's possible deregulation, may not have to trip over those regulations in the near future.
Fair enough. Herman, thank you so much for joining this morning.
Thank you.
Great to get you on. Herman Chan of Bloomberg Intelligence. Coming up, investors pull away from currencies as they flock into perceived safer trades. We're going to look at the debasement trade. Coming up next, this is Bloomberg Open Interest. Growing concerns in some of the world's largest economies are adding momentum to the so-called debasement trade. Investors are flocking to Bitcoin, gold, and silver while pulling away from major currencies. Joining us now is Bloomberg Intelligence Senior Commodity Strategist Mike McGlone. Mike, great to see you this morning. And look, the gold trade has been happening for some time before a U.S. government shutdown. How do you separate some of the longer-term trends versus these near-term tremors that are causing the movement into the precious metal?
Well, that's what I love about you, Dani. I think you know how to nail exactly what matters. The long-term trend is we have to be very careful about the recency bias here of debasement. Gold's up 50% this year. It's approaching $4,000 an ounce. That's a significant resistance level. If you measure it versus like a 40-month moving average, you have to go back to 1981, the last time it got that expensive. And Bitcoin is going up because there's a rush into it. But the big difference is Bitcoin's a risk-on asset, and it has millions of companions, other cryptocurrencies. And gold is historically a risk-off asset, and there's only 4 precious metals. You mentioned silver, we have platinum and palladium. So a basket of precious metals this year is up about 50%. The basket of cryptocurrencies like the Bloomberg Galaxy Crypto Index is up half that, despite the fact these cryptos have double the volatility, double the risk. So to me, going forward, I put on my risk management hat, and I'm very worried about what the market's doing here per this rush into these type of assets when they get really expensive. And we've seen this before. So it feels to me a little bit like 2007 after the Fed first cut rates and then everything went downward. So I'll end with this. Cryptocurrencies might continue to do well and maybe even do well versus gold as long as the stock market goes up. And that's the big risk. We've had the big debasement in 2021, and now people are trading for the last big trade. The next big trade might be more deflation.
When we were talking about gold going to 3,000, Mike, there's this conversation, though, of demand destruction, that it couldn't continue even further. Is it fair to say that 3,000, 4,000, whatever it is on gold, that's not really part of the narrative?
Well, we understand central banks are the biggest buyers, but I always like to separate the noise from the market. There's always a reason for markets to get overbought. Then you have to get away and put on the risk management hat and say, so how expensive are they? So versus 40, 50, 60-month moving average, you have to go back to about 2011 or 2021 or 2081. Very significant peaks in gold. So I look at 4,000 as we're probably going to print there. And I think it's going to be one of those things you're supposed to be selling when they're yelling type of levels and be very careful. And then Bitcoin and cryptos are, yeah, they're going up, but I'm really worried about they're going up. They're risk assets, but they've been underperforming gold. So to me, gold's getting pretty significant threshold. I've been bullish. At some point, you have to just say it's very prudent to take profits, and I suspect we'll see some of that.
Hey, Mike, this was awesome. And not just because you started this conversation by complimenting me, which I'm sure you say to all of your favorite Bloomberg TV anchors. Thank you so much for joining. Mike McGlone of Bloomberg Intelligence, always a joy. Coming up on the show, the White House raises pressure on congressional Democrats as the U.S. government shutdown enters its second week. We are live in Washington, D.C. for the latest. That's coming up next on Bloomberg Open Interest. The White House is turning up the heat as the shutdown drags into a second week, threatening mass firings of federal workers if Democrats don't back the latest spending bill. Michael Shepard, Bloomberg senior editor, joins us on the latest from Washington. And Shep, this is where the rubber meets the road. In talking to Wall Street, the conversation is this shutdown matters this time if mass firings actually happen. To what degree is this a threat that the Trump administration would follow through on?
They have certainly tried to make clear that they intend to follow through on it to the letter. It's questionable whether it is on firm legal ground. Federal employee unions are already challenging such a move ahead of Trump actually following through. But we have seen since the start of the administration the president's desire to reduce the federal workforce. His budget director certainly mapped out that plan with his Project 2025 well ahead of Donald Trump taking the oath of office. So they've laid the groundwork over the past several months to try to do something like this. And the shutdown is presenting them as what they see an opportunity to seize on the moment and maybe make some further reductions in the federal workforce. We have seen courts reject some of those moves, but they are trying to make it stick and really make some of the pain felt at the federal worker level. And Dani, remember, there are 750,000 federal workers currently furloughed as a result of the shutdown, and that's also brought a halt to a lot of non-essential government services. So this is starting to have a practical effect, and this is what Wall Street is looking at as well. And we are not seeing very much sign of either side giving ground, Dani. House Republicans don't plan to come back at all this week, and we do have a vote later today in the Senate that will be kind of this Fisher Cup bait moment for the administration. If Democrats don't jump aboard this plan to keep the government open with that vote, they are threatening to follow through on the firing threat.
Do the Democrats seem like they are budging at all, Shep? Does it seem like we are any closer to a deal than we were just last week?
No, in fact, at the end of last week, the talks between the two sides really began to unravel. And over the weekend on the closely watched Sunday shows, we saw the signaling from each side showing that no one was ready to give ground yet. And we're not seeing any signs of negotiation lines reopening. In fact, today, the top House Democrat, Hakeem Jeffries, challenged Speaker Mike Johnson to a debate over all of this. Democrats see something at stake here that is much larger than just the shutdown. It's all the Affordable Care Act subsidies that support more than 1 million Americans in their ability to access health care when they need it, and also Medicaid cuts that actually began to take effect through the tax and spending bill that was passed earlier this year on partisan lines. It was a centerpiece of Trump's domestic agenda, but Democrats see cuts to Medicaid services resulting from that. And taken together, those health care concerns for Democrats represent an argument and a talking point against the administration and against Republicans in Congress as they look ahead to the midterms as well.
Hey, Shep, thank you so much for that. That's Michael Shepard in Washington, D.C., the sixth day of a government shutdown. By the way, if it continues through the rest of the week, we'll miss out on trade deficit data, on initial jobless claims, and federal budget data. We will, though, get FOMC minutes. Those come at the middle of this week. We'll get more idea of just how big the split is on the FOMC, with your equity market heading towards its 32nd record high. Coming up on the show tomorrow, Sinead Colton, Grant of BNY, and Liz Ann Saunders of Charles Schwab. Plus, I will be at the Citadel Conference speaking with former World Bank President David Malpass and Lightspark CEO David Marcus. That's at Citadel's Future of Global Markets Conference. All of that coming up tomorrow. This is Bloomberg.